Now let's move on with the next subtopic in financial management advanced level. My name is Mr. William of Fatima Institute Center for CIFA Studies. My contacts are there 0727 87 10 93. In case you need any assistance with your studies, you can contact me via that number as it appears in the footnote of this textbook. I'm a publisher as well as an author, so in case you need books to do with CPA, that is Certified Public Accountants, or CIFA, Certified Investments and Financial Analysts, contact my number down there and I will assist you. We still have classes, physical classes, and online classes. We are based in Dhaka. We take our next discussion, and this is simulation analysis. You can see what is appearing on our screen, a little bit of explanations, but my focus will be on the calculation. You can just go through those notes there. I believe you have this textbook, and it is page 82. Simulation method involves the use of random numbers which can be generated using a computer or from a random number tables. The method is used to establish the method is used to establish the dynamism of a project, i.e., the project's cash flows over time. For capital budgeting, it's used in establishing future cash flows of a project over a long period of time where all the cash flows in the short run are available. The use of random numbers eliminates personal judgment and bias or prejudice. Applications of simulation analysis in business. We can apply the simulation analysis in business in the following areas. 1. Inventory, control, and management. Number 2. Queuing system design, implementation. Number 3. Production planning. Number 4. Asset replacement decisions. And number 5. Weather forecasting. The procedure in simulation. The first thing when you are carrying out simulation analysis is construction of a probability distribution for each variable which will influence the capital budgeting decision, e.g., the economic life. Number 2, from the probability distribution, develop cumulative probabilities. These steps are very critical because they are the ones which we will be using when we move to the computation. So the first thing is to construct a probability distribution for each variable. Variables here may be selling price per unit, or variable cost per unit, or sales volume. So you construct probability distribution for each variable which will influence the capital budgeting decision, such as the economic life. Then your step number 2, from the probability distribution, you develop cumulative probabilities. Let's move to the next page, that is open page 83. Go to page 83. We are discussing these steps. When you go to step 3, you open the next page, and that is page 83, the advanced financial management study text. Step number 3, you can see that we are saying, on the basis of cumulative probabilities, develop random number range which will depend on the number of digits to which the probabilities are given. Then step number 4, generate random numbers if they are not given. The last step, number 5, assign the random numbers to the various key variables according to the random number range, then simulate the project for the desired number of simulation from which net present values, expected net present values can be gotten. Let's have advantages of simulation analysis. Advantage number 1, it helps the manager to fully understand the project during the model building. Number 2, it can be used to train the decision makers. Number 3, it can be used in areas where analytical techniques are not available or would be too complex. Advantage number 4, it provides the manager with a distribution of the project's outcome and the values of decision criteria, i.e., the net present value and the internal rate of return of each trial. Number 5, it allows decision makers to vary many decision variables simultaneously and randomly, which reflects what is likely to occur in practice. Number 6, it is cheaper and less risky than altering the real system. With 4 disadvantages, and 1 is that it can be costly. Number 2, it is time consuming. Number 3, it is based on probability, hence it can give misleading results. Number 4, a complex simulation problem may require experts to develop. Understand the steps that we will be using, and then we can take an example together. Now, this question, because it is on page 83, if you have our study text, the question or this example is in page 83. The solution is on page 84. So I recommend that you write this question so that when we move to the next page, you'll be able to make a follow-up more easier. Let's have the question, which is in form of an illustration. Galanema Limited is considering to introduce new cheap plastic rulers into the market. This will involve investing in a new plant at a cost of shillings 280 million. The plant is expected to have a useful life of 5 years, at the end of which salvage value will be nil. The firm's policy is to depreciate all of its fixed assets on a straight line basis. Due to market uncertainties, the unit selling price, unit variable cost, and annual sales volume of the new plastic rulers have been estimated stochastically as follows. With unit selling price together with the respective probabilities, these are the variables The unit selling price is shillings 35, shillings 30, shillings 50. The respective probabilities are 0.30, 0.40, 0.30. Then you have unit variable cost. The values there 15, 10, 25. Respective probabilities 0.20, 0.50, 0.30. Then annual sales volume, these are units, value 4 million, 7 million, 9 million. Now these are units. Then the respective probabilities 0.10, 0.60, 0.30. Additional information. Number one, the firm expects to incur fixed operating costs excluding depreciation of shillings 30 million in each year. Number two, the company's cost of capital is 17%. And number three, the company's tax rate is 30% required. The expected net present value of the new product. And number two, simulate the net present value using the following random numbers. So the random numbers have been given there. They are the ones that you'll be using for the purpose of simulation. Okay, so go through the question once again. Try to understand the variables that we have. Is the unit selling price, then we have the unit variable cost and the sales volume in units. We will be calculating the expected selling price, whereby you'll be using the probability times those values there. The expected selling price will be 35 times 0.3 plus 30 times 0.4 plus 50 times 0.3. You get expected selling price. Then calculate expected unit variable cost 15 times 0.2 plus 10 times 0.5 plus 25 times 0.3. Expected annual sales volume will be 4 times 0.10 plus 7 times 0.60 plus 9 times 0.30. So when you move to the next page, you find those calculations there. So just be taking the expected unit selling price, you'll be taking the value given times the respective probabilities. You sum up the summation of those figures. Then expected unit variable costs, the values given times probability. You sum up the figures. Expected annual sales, the same. So go through that question and you understand the steps that we have explained, the steps that we follow when doing simulation. Another important thing for you to understand is the accumulation, how to accumulate cash flows. That would be quite important. So let's move to the next page. We turn now to page 84. I believe you have the book with you. If you have the book with you, that's okay. Just move to page 84. You can move to page 84. That will be okay. Now, if we move to page 84, this part I have explained to you what you're supposed to do up to this point here. Expected net present values, because that is what they are asking us, the expected net present values. You take the expected cash inflows times present value 100 factor for 5 years interest rate, you minus this your capital outlay. Now the expected net present value of the new product expected selling price, I've said you'll be taking that 5 times 0.3 plus 30 times 0.4 plus 50 times 0.3, you get shillings, that's 7.5. Expected selling price. The expected selling price, I believe you know what I'm saying. I believe you understand what I'm doing. I'm just picking that 5 times 0.3 plus 30 times 0.4 plus 50 times 0.3. You sum them together. The expected selling price. Then the expected unit variable cost, you'll be picking 15 times 0.2 plus 10 times 0.5 plus 25 times 0.3. Then expected annual sales, you'll be picking 4 million units times 0.10 plus 7 times 0.60 plus 9 times 0.3. I believe you have understood where I'm getting those numbers from. You understand where I'm getting those numbers from. So when you come back here, you see that the expected selling price, we've gotten shillings, that's 7.5. Expected variable cost, we have gotten shillings 15.5. Expected unit costs, we have gotten 7.3 million units. An important concept of DTS will be put into consideration, and DTS is calculated by taking depreciation times tax rate, and depreciation is calculated by, we are using straight line method. You take the cost of the asset minus scrap value. Scrap value is also called salvage value. You divide by expected useful life and you multiply the answer by tax rate. So basically, depreciable tax shield is given by depreciation times tax rate. In this case, you have to calculate your depreciation by taking the cost. We are told the cost of this project was 280. The cost of this asset was 280, and the salvage value was you're told Galanema Limited is considering to introduce a new cheap plastic rollers into the market. This will involve investing in a new plant at a cost of shillings 280. So the cost of the plant is 280 million. The plant is expected to have a useful life of 5 years, at the end of which salvage value will be 0. So there is no salvage value. So to calculate depreciation for this particular asset, what you do is that you will take the cost, which is 280, minus salvage value. The salvage value is 0, divided by expected life of 5 years, multiplied by tax rate of that percent, and our DTS is 16.8 million. Now, the expected contribution per unit, we know that contribution is given by selling price per unit minus variable cost per unit. So the expected contribution per unit you can see we started by calculating expected selling price, which we got that 7, this figure here, that 7.5 is the expected selling price. We minus variable cost per unit, which we got this figure here, 15.5. So that's 7.5 minus 15.5, you get 22. So 22 is the expected contribution per unit. Then when we start calculating expected net present value, you will be taking the expected contribution minus fixed costs minus depreciation. Let's see our expected cash flows now. The expected cash flows now will be given by the expected contribution, that the expected total contribution will be taking expected selling price, which is at 7, that's 7.5, minus expected variable cost, 15.5, and you multiply by the expected units. The expected units is 7.3 million units. We expect 7.3 million units, and for us to get expected total contribution, we multiply that by that 7.5 minus 15.5, and you get 160.6 million. That's the expected total contribution. Once you get contribution, you less annual fixed cost. We've been taught from the question the annual fixed cost. Now that statement, I believe what I'm saying is the right thing. Is that what we have been told? Hopefully, that is what additional information number one. Additional information number one, we are told the firm expects to incur fixed operating costs excluding depreciation of shillings that million in each year. So that is the 30 million that we are lessing there. So you less that million. So we've taken the expected total contribution of 160 million. We minus annual fixed cost excluding depreciation of that million. Profit before tax is 130.6 million. We less that percent tax. So that percent of 130.6 is at 9.18. Profit after tax is 91.42 million. We earned back DTS. We earned back depreciable tax issued of 16.8. This 16.8 is how we calculated that. The depreciable tax issued is given by cost of the asset minus salvage value over expected useful life times tax rate. We got 16.8. We earned back that, and our expected cash flows is 108.22. Now, the expected net present value now, remember, the expected cash flows here is 108.22, and this project has useful life of 5 years. It implies that the 108.22 is an annuity. This project will generate 108.22 each year for the next 5 years. So we use the concept of annuity. This is a formula if you are able to use your table, you can just pick your table. You look at 17% and 5. If you are calculating using your own calculator, we take 1 minus into brackets 1 plus rate. The rate we are told was 17%. The cost of equity or the cost of capital was 17%. Raised to negative 5. This 5 is the n, the number of years. The project has expected useful life of 5 years. Then you divide by rate, the same 0.17 or 17%. Then you minus initial capital outlay. We minus the initial capital outlay. This project cost 280 million, and therefore the expected net present value is 66.23 million. So we have answered part 1 of that question, the expected net present value. So this section here is quite important, but you should have calculated the expected cash flows using these steps you have followed here. The expected cash flows of 108.22. Note that the implication is that each year this project is generating 108.22 million, and those are annuities. We calculate the present values of those cash flows, then we less the initial capital outlay of 280 million. 280 million is already given in the question, and our expected net present value is 66.23 million. Other similar workings are here. You can just go through these and understand that. Now let's go to simulation now. Simulation, we want to do the simulation. Let's start by simulating the selling prices. The selling price says, you've seen the selling price from the question. Unit selling price, we have that 5, 30, and 50. Probabilities, you have 0.3, 0.40, and 0.30. So be fast accumulating these figures. You know how to accumulate these figures. So let's have the first workings for the unit selling price. So have in mind these values and these probabilities. Now what will you do in that case? What you will do is that the selling prices are being given there, that 5, 30, 50. Probabilities are being given 0.30, 0.40, 0.30. Cumulative probability, you start with 0.30, then 0.30 plus 0.40, you get 0.70. 0.70 plus 0.30, you get 1. These are your cumulative probabilities. Then random range. Now these numbers are in hundreds. So if you want to understand this one faster, we have the upper limit and the lower limit. And because these numbers are in hundreds, your upper limit, you just minus 1. You minus 1. To get the next lower limit, you plus 1. So here, because these numbers are in hundreds, it means 0 up to 30, but don't you say 30. You can say 0.30 minus 1. You get 29. So random range numbers will be 0 up to 29. Then the second random range number, 29 plus 1 is 30. This is 70, so 70 minus 1, 69. So 30 to 69. 69 plus 1, 70. Now this is 100, so you say 100 minus 1, 99. So these are your random range numbers. Your random range numbers. Then variable cost now. If you look at your variable cost, you refer to the question. You just go back to the question, you find variable cost, we have shillings 15, 10, 25. Probabilities 0.20, 0.50, 0.30. Cumulative probability 0.20 plus 0.50 is 0.7. 0.7 plus 0.3 is 1. Random range, these numbers are in hundreds. These are two decimals. So 0 up to 19. We are saying 20 minus 1. 0 up to 19. 19 plus 1 is 20. 20, this is 70. 70 minus 1 is 69. 69 plus 1 is 70. This is 100 up to 99. The other now is for